In this video, we are going to cover two of the international accounting standards. The first one, we will focus on inventory, and the second one, we will focus on events after the reporting period. So first and foremost, we are going to have a look at IAS 2 covering inventories. So, inventories are assets that include the following. So they will be held for sale in the ordinary course of business, they will be in the process of production, or they may be materials that are going to be used in the production process. So how do we measure inventory then? So in accordance with IAS 2, inventories are measured at the value at lower of cost and net realisable value. So what do we mean by each of these things then? By cost, we simply mean how much did it cost us to purchase? What was the cost of conversion? And how much did it cost us to bring inventory to its present condition and location? Our net realisable value then is the estimated selling prices minus our costs to completion less our costs to sell. So costs that are not included in inventory but instead are expenses in the statement of profit and loss are as follows. Do be careful with this because they will never be included in inventory in the financial statements. So any abnormal amounts of wasted materials, labour or other production costs, any storage costs, any admin costs that do not contribute to bringing the inventories to their present location and condition, and also any selling and distribution costs. These would all be an expense to the business and thus would be recorded in the statement of profit or loss. So we have different cost types which you need to be aware of. So purchase cost. This is going to involve purchase price, any import duties, any handling costs, and any costs which are directly connected with the acquisition. We then have conversion costs. So these are going to be direct labour costs and any allocation of fixed or variable overhead costs incurred in the production process. We then have variable production overheads. So these are indirect production costs, such as your heat, your light, and your power. We then have fixed production overheads as our final cost type, which is indirect production costs, which could include depreciation and factory admin costs, just to give you an idea. So there are some approximation methods that can be used when calculating costs. So the first one is FIFO. So essentially, our closing inventory is going to be valued at the most recent purchase price because our oldest inventory is going to be sold first. First in, first out. Alternatively, a business may choose to use AVCO, which is the weighted average cost, which will be calculated by taking the total purchase price across all units in that period and divide those by the total number of units purchased within a period. So essentially, it's just the average cost method. So IAS 2 then does also state that we may need to disclose some things. So an accounting policy must be adopted, including the cost formulas, and we have to disclose in our financial statements which policy and which cost formula have we used. The total carrying amount will be disclosed as a note in the financial statements. So raw materials, work in progress, and finished goods all need to be recorded. Inventories carried at net realisable value need to be noted. Inventories recognised as an expense during the period as well. And also any detailed reasoning as to what has led to the write-down of inventories and to their net realisable value. So that's the basics covering IAS 2. So we are now going to move on to IAS 10, which details all of the events after the reporting period and how we deal with those. So what is the purpose of IAS 10 then? So essentially, it defines any events that occur post the reporting period should be recognised in the financial statements. So IAS 10, the definition, or the official definition, is that those events, favourable and unfavourable, that occur between the end of the reporting period and the date when the financial statements are authorised for issue. So we do have some adjusting events, but we also have some non-adjusting events, and you need to know the difference. So, adjusting events. These are events which provide evidence of conditions that existed at the reporting date. Non-adjusting events are going to be events that are indicative of conditions that arose after the reporting period. So, just to give a few examples then of adjusting events. So it could be a discovery of fraud or error that existed prior to the year end. It may be that selling inventory post year end for lower than cost price. It may be evidence of a customer going into liquidation. It might be an insurance claim that is completed relating to an event occurring prior to the year end. Or it might be a court case being completed before the reporting date. And it could also be determination after year end of sale or purchase price of assets sold or purchased before the year end. So they were the adjusting events. We now need some examples of non-adjusting events. So these are not limited to, but may include plans for restructuring, plans to discontinue an operation, destruction of assets through natural disasters such as fires and floods. It might be an acquisition or disposal of a subsidiary after the year-end date. It could be due to strikes or perhaps any other disputes that you may have with your labour force. It might be share capital transactions after the reporting date. Equity dividends declared after the reporting period but before the financial statements are authorised for issue. And it could also be due to a change in taxation or exchange rates after the reporting date. Going concern then, a term that you should be familiar with. So financial statements for the current period should not be prepared on a going concern basis if an event post the reporting period indicates that the entity is no longer a going concern. So in order to help with this situation, we have something which is referred to as the breakup basis. And essentially, this is just where all assets are going to be valued at the lower of cost and net realisable value, and all liabilities will be classified as being current. This would, however, only ever be used in the event that the entity was no longer a going concern. Disclosure then. So, a non-adjusting event post the reporting date should be disclosed in the notes if there is a material impact upon the financial statements. Within that note, it should be disclosed the nature of the event, the estimate of the financial effect before accounting for taxation. If it is unreasonable to do so, an explanation needs to be had. And the date at which directors approve financial statements and the date at which financial statements are authorised for issue should also be included in that note. And that's all there is to learning the basics of IAS 10.